What's going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be checking out Marvell Technology stock because the stock is now up 23% today after they reported good earnings and they raised their guidance. So this stock is now, it was a $100 billion company, but now it's a $102 billion company. So it's moving up. And if we look at the last year, this stock has had a fantastic performance, up 126%. Then if we check out their financials, we can see that revenue has not been necessarily bad, but it's not very consistent. And so there's lots of ups and downs here, but the last couple of years have definitely been showing some strength, but still it's just not something that it's not ideal, right? Then net income is a huge problem here because again, keep in mind, this is over a $100 billion company now, and they lost money the last 4 years. So that's where there's a big issue is I'm not really a big fan of buying into money losing companies unless it's at a very cheap valuation because why are you paying a high premium for a company that's not even making money? So, and especially, so they lost what, $1 billion in the last year, and they did over 5 billion in revenue. See, so those numbers are just not good. The cash to debt ratio has gotten out of hand now. We're up to over $4 billion of debt and right under $1 billion of cash. So not that great of a ratio there. And as usual with money losing companies, they're going to have to raise their share count because how else are they going to bring money into the company? And so from 2018 to now, we've seen the number of shares go from 500 million to over 860 million now, which is definitely not going to help the share price out. But with that being said, the share price has actually done a fantastic job the last 5 years. We're up 346% in the last 5 years. That's a really big jump. So then let's take a look at the valuation, right? I mean, I already know I wouldn't buy this company at $100 billion when they've been losing money. But then you look at the price to sales, we're up to 15 times price to sales right now, which is by far the highest it's been, right? And I mean, what happened 3 years ago, right before we had our giant crash? The stock was at 13 times sales. It went all the way down to 5. Okay. And right now we're above that. Right now we're at 15, approaching 16. I mean, it probably is over 16 now that we can run the numbers, but it's probably over 16 now that the stock is up so much today. But the good news is that analysts have very strong projections coming up. We have all pretty much not much growth expected for this year. The revenue and EPS is pretty much flat from year over year, but next year we're looking at an EPS jump of from 1.5 to 2.7, which is insane. So if we run those numbers, we're looking at, let's see, if you buy today, you're paying 43 times earnings for next year, which is a lot. By most stocks, that's a lot, unless you're a huge growth company, which is this stock is putting up good numbers. But again, they're losing money. Let's go to the trailing 12 months. How's the last couple of quarters looking here? It's gotten worse. The last quarter, they lost $1.4 billion in a quarter. So again, I don't see why you would want to own this. I mean, that's great that EPS is positive though, but not really a great situation. Revenue jumping 40% up to 80 or not 8 billion dollars. And so really you're paying, let's do okay, $102 billion company divided by $8 billion of sales, you're paying almost 13 times. So we're pretty much right around here. Still overvalued. So that's really all I have to say about this company is just it's not attractive. The valuation is super overpriced right now, and the financial metrics are not good. So this is not a stock I will be buying. Thank you for watching. I will see you in the next video.